So, good afternoon, good evening, good morning, depending on what time zone you're in. I hope everyone is doing great. Today, we are doing day three, part three, of our futures workshop that allows you to build a system and develop a strategy that allows you to trade any market. Now, I'm doing this specifically because it hasn't been an easy time to trade in the last few months or even years, seeing as markets have been sideways, non-directional, and then you get sweeps to the upside and the downside. So realistically, I think this is going to be a huge benefit to a lot of people that might only be used to trend trading or only good at trend trading realistically. So in part three, what we're going to be doing, we're going to be introducing how futures move based on distributions and profiles. Now, the last time that we talked about market participants and how market participants actually shape up moves in the overall futures market. So we're going a step further here, and we're going to spice this up with some actual charts. So in the workshop layout, right, I just want to break this down again. Day one, we have covered already the first 2 days, introduction to futures and introduction to futures markets and market participant psychology. Those are very basic things that I think everyone should know and understand as or to become a futures trader realistically, right? You have to understand what asset you're trading, how the participants actually interact in this asset, and much, much more. So today we're getting into that past that half mark way hurdle, where we're going to be talking about the introduction to futures movements, profiles, and distributions. And we're going to be talking about order flow reading the DOM tomorrow. And then on Sunday, we're going to wrap it up as we talk about developing as a futures trader. So let's dive into this. Remember, the goal, I want to make sure everyone always understands this. That's why we're going to repeat it at the beginning of every single one of these classes. The goal is to understand how to navigate any market condition, the futures market, using futures equities, regardless of the volume, the volatility, the movement, whatever the case is, even if you do have doubts. So in the next 30 to 45 minutes or so, we'll be breaking down those three top tools to stay consistent regardless of what happens in the market. And those tools are going to revolve around volume profiles. My promise to you, using these very simple three tools that you can apply to any futures market, regardless of the market condition, you can identify opportunity and large moves, even if we're trading in a range, or find trends, especially like today, and create a step-by-step system to create confidence in how you trade the markets, regardless of the speed of the movement. So if you hear me out until the end, today we're going to throw another bonus gift your way. We're going to be sending emails after this as well. And I want to talk about how we broke down the week. This chart might not mean too much to you, but if you were in the live futures room with us, you've probably seen this chart multiple times. This week, we stayed very decidedly long into the lows. Regardless of the trading session, my plan was to see either a drop and a pop or a rip, right? Pretty much from the beginning of the session. Today was like every other day, realistically looking for that press to the upside. So I just want to do a quick review of what had happened today. Today, these profiles, we're going to obviously talk about them, but give you an understanding of what these profiles mean and what they are. This is the extended hours trading session. This is the regular trading hours session. So based on this, we can divulge what this might mean, right? And create an informational hypothesis based on what had happened overnight, what's happening in the overall distribution, to get an understanding of the projected move for the regular trading hours session to a higher degree of certainty, right? Obviously, it's never going to be 100%, but the thought process based on these simple volume profiles creates the anticipation of the coming move for that day. So today we started off by saying, hey, if we open the markets above 4250, right? We're opening above a key distribution block on a larger profile, suggesting that price is to rally towards, right, 4260, which is the start of another distribution, and 4305, the top of that distribution. So the general consensus today was looking for pullbacks. So the market started ripping pretty much off the open. And the first pullback I tried was 61. We got up into 67, right? And then rotated 65 for a very, very long time. So not the craziest of move. The second move that I was talking about was from 51 to 53, where we got that larger bounce. And eventually that was pretty much the low of the day. And we continued in towards that 4,300. Now, I'm not going to hear I'm not going to sit and pretend that I caught this whole move, but caught a decent chunk of it as we continue to rebid throughout the rest of the session. So this is what I'm going to explain to you guys today. If you were in the live room, you saw everything that unfolded and what we had talked about, those trades, those ideas, why we were talking about them, the setup and everything. So this is the basis of what I'm going to cover today. This is the basis of what we're going to be breaking down, how to understand direction, how to understand distributions, how to understand what the highest probability move in the market is, up or down realistically. So this all starts from what we had talked about yesterday, right, into the end of the session where we talked about distribution theory. So in today's agenda, I'm going to be breaking down only two specific tools that you need to understand market direction, right? Their profiles. We're going to review the volume profile quickly. We're going to talk about what it is exactly that we're looking for in terms of these profiles. We're going to talk about creating a daily trading plan because this is a vital part of every trader's morning routine. You get up early, you look at the markets for a specific purpose to create a trading plan that's expected to have very good opportunities throughout the day. And as long as you can follow that trading plan, the expectations are for you to end green on the session. So creating a trading plan and creating the right trading plan is very important on a day-to-day basis, right? I never sit down and just see what happens in the market. It doesn't work that way, right? So we're going to conclude and then what to expect next time. As you probably all know, we're going to be talking about the depth of market realistically. So the age-old question, right? Can you predict market direction? Now, predicting market direction, a lot of people take this the wrong way, or a lot of people are adamant that you can or cannot, right? But if we redefine this slightly, when we put some quotations around predicting the market, where the market is going, and how is more of a question of how you can increase the probability of understanding the next move. Meaning that you can anticipate market directionality to a certain degree of probability, right? You can assign probabilities to the expectation of a market move up, down, sideways based on the information that you have in front of you. So we can do this by introducing cumulative volume profiles as well as session volume profiles. It's going to be a very heavily based volume profile class today. And this is what I want to talk about. Quote unquote, predicting market movement. So it's not necessarily predicting, but it's anticipating the directionality and the levels at which price is going to trade based on the information that we have in front of us. The last few days, we were able to discern what the high probability move of the market would be. And this is what I mean by quote unquote, predicting market movements, right? So one of the plans on the 31st was as such that we tried to hold out the 95, blah, blah, blah. The whole point of this was I expect to see sellers into the 98/4200 and or into 4208.10. That's the ideal for sell area for sell to come. My expectation is the mid 70s. So the highest we traded was like 4204 or something. Then we dropped into the mid 70s and popped from there. So that's the anticipation of the move. How could we predict that? How could we predict a drop and pop in those exact levels? Well, it's based on the volume profile distribution theory. Then again, June 1st. The idea here is I want to see a drop and then pop, right? The last level I'm looking for longs is going to be 4182, right? We dropped a bit below that, and then we got that rally back into, right, the target 4208.10. We exceeded that target and continued the rally. Today was no different than the other days. Today, I was looking for a deeper pullback. I'm not going to lie. I was looking for the mid 40s. The lowest we got, right? We started ripping off the open. The lowest we got was the 50, but we adjust our strategy and the idea was still there. Long until we see sellers come in, right? So how is this possible? How 3 days in a row, multiple days in a row, what the hell happened here? So this is the result of the last few days, right? This is the 31st right here. This is the opening print right here. We get a pop and drop. This is 4204, mid 75s, right? 75s print when we get that rally into the close, right? Then again, we get a drop into the low 80s and then rally into the close, exceeding my target of 4210 and then some, right? And then today, same thing. So I'm going to talk to you guys how we can create these about how we can create these trade plans and how we can identify the directionality and the movement of the markets overall based on just very, very simple tools that every trader has access to. This is the beauty of this. It's not an indicator. It's not something that's auxiliary. It's not something that's only available to a handful of people. It's not something that's complicated to understand either. It's just very basic volume profiles. A very quick review of the volume profile. We have multiple areas of a volume profile. If you want to learn more about this, there's so many resources out there. I don't want to dive too much into the basics of a volume profile when you can watch like tens of our YouTube videos and get a lot of information right there. Here, I want to show you the application of these charts and how to necessarily use them to trade any market. That's the purpose. So if you don't really know too much about volume profiles, again, like there's so many resources. That's why I'm going to just run through this fairly quickly. And we're going to look at the real meat and potatoes of this stuff. So volume profiles, right? They have multiple different areas. You have a value area, you have a value area high and low. You have a point of control, you have ledges, you have distributions, and then you have cumulative versus session profiles. A value area, very, very lightly put, is the majority of the volume that's created in a session or cumulative sessions. A value area is 70% of the volume that's trapped between two levels, which happen to be the value area high and low. The point of control is the largest level of volume traded on that volume profile, regardless if it's a session or a cumulative volume profile. The point of control is going to be inside the value area at all times. Ledges. Ledges are what encompass the distributions. Ledges are areas where price drops off super aggressively from a high volume to a low volume node. You can see this is a ledge where you have a lot of volume and you have a drop off. This is a ledge. This is a ledge, right? These are ledges where volume drops off. A distribution is the cumulative belly block that is entrapped by two ledges that creates these areas. Distributions are one of the main things that we're after. When we can find very large, thick distributions, we can apply distribution theory or auction theory to analyze the potential of the move, which is exactly what we did today in our live trading room. Then you can have cumulative sessions versus single sessions, right? Session profiles are each individual session, extended hours trading and regular hours trading, or extended trading hours and regular trading hours sessions have each their own individual profile. And then when you have a cumulative profile of multiple days, that's where you can find these very large distributions. Because when you see where volume has been traded over weeks, months, years, there's a lot of validity in those areas. So it's very important to understand how cumulative session profiles work as well. When we talk about understanding market directionality can be understood by using distributions and distribution theory. Remember yesterday, we had talked about how prices tend to move from balance to imbalance, right? You have a balanced area, which is what we would call a distribution, and price has found its home there, right? Price is very happy about that. It's having a good time, right? It's nice and warm. So price in this normal distribution, and again, value areas aren't necessarily going to be normally distributed like this. This is why we focus on distributions more so than value areas. Keep that in mind. So price, when it's within a distribution, it rotates as happy. It's doing what it wants, right? And then at a certain point, you get an extension move that breaks the distribution. How these movements work in the market, price is exploring other distributions, higher or lower, to find validity in that move. And this is how price action moves, right? Price exploration happens from distribution to distribution, right? So this is how the market moves. And when we understand that, and more so when we understand where these distributions are, we understand what the directionality in the market is, right? Why would I be bullish if the markets ran so aggressively? I remember someone asking me this morning, aren't we a little overextended? Aren't we a little overbought? Well, that's a good question. I wouldn't necessarily think so, because what's just happened is price has escaped a prior distribution from a compressive period and has run into an expansion and has now accepted another compressive period from the past. So the expectations are price to remain within that compressive period. So major distributions, prior session volume profiles. These are very, very important to understanding directionality in the market. When we look at distributions, finding distributions are mainly found on a larger volume profile chart, right? You look at multiple days at a time of a volume profile, and that's where you'll find the big distributions. They're usually very large, so a large distribution can be defined at like 30, 50 points realistically. You're not going to find large distributions that are like 15 points. You're looking for these very thick areas which present the opportunity for those very large moves in the market. So this gives us an overall quote unquote macro view of the market, what the market sees, how the market seeks balance. So, for example, you can start on TradingView, right? This is a very basic tool that a lot of people are familiar with. If you don't have Sierra charts, if you're new to Sierra charts, I suggest taking a look at TradingView and seeing what's going on there on TradingView, because TradingView, it allows you to do something that not all Sierra, like for me, Sierra charts doesn't allow me to do this, but TradingView allows you to see cumulative volume profiles, right? Meaning that you get cumulative contract sizes on the S&P 500 futures dating all the way back until wherever you want, and that volume is reflected on the chart. In Sierra charts, if you don't have access to a continuous contract, when the contract expires every quarter, you lose that volume profile data. So I prefer looking at my large distributions on TradingView. So let's go find them, right? Let's take a look at TradingView. Let's take a look at how we can identify some of these large distributions, what some of the rules are, and what we should be looking for. So here we are. This is TradingView, right? And we're taking a look at these distributions here. So we can find distribution blocks on TradingView. I've just jumped into an hourly chart here to make sure that we don't spend too much time doing this, but we're just going to go over just some very key major distributions. So when we look at this on TradingView, distributions are bellies in the volume profile that stick out. There are a bunch of high volume nodes that get clustered together. And on each edge of the distribution, you find a very strong drop off in volume, creating a ledge, right? So in this scenario, we have a larger distribution that spans from 4120 into 4160, right? A 40-point distribution. You can see how prices hold out. When prices reject, they hold the tops, right? So on and so forth. So when we map these out, right, we can identify what the expected moves of price are. So expected moves of price realistically, right? You can see there's a distribution that I mapped out here into like these higher 50s that runs up all the way into the 4,300. And once we accepted that, we got that leg to the upside. So if I zoom out and we look at other areas, right? If I get consolidative moves somewhere, this wants to, so just zoom out on TradingView like that. So we have another distribution down here into these lows. We have that 4044 down into like the 39, like 45 or so. You can see how this distribution kind of shapes up. Once you get the actual data, you'll see that you have this actual distribution. So when you have TradingView, you can use like the visual you can use the visual volume profiles. You can use the visible range volume profile, which allows you to see what is currently on the screen, right? So if I move the chart around, the distributions will change, or I guess the volume profile will change. The distributions don't generally change. So the premise of this is trying to find where these large blocks of distribution sit so that we have those areas of balance in the market. And those areas of balance can give us an indication of whether price wants to either stay compressed or run to the upside or downside realistically. So the whole premise of finding all these distributions is finding where price is balanced and finding very key areas to trade at and within. Because when price runs away outside of a distribution, that means we're going from a compressive to an expansionary period. And the idea is if we want to stay expansionary, that prior distribution top should hold, right? So in this scenario, I don't even know if it's going to allow me to do this, but in the scenario that we had today, we have the top of the prior distribution at 4250, and then we got the move above, right? We got a strong rejection and push into the 4270s. And when we pulled back into that prior top distribution, 4250s, we got our expected continuation. So it's very important to understand where your big distributions are, because we can start identifying where the market's expected to go and what levels the market's expected to hold, right? We can go a step further with distributions and find ledges. Ledges are very just simply defined as big drop-offs in volume from high volume node to low volume node. So not necessarily low volume nodes, but the drop-offs into low volume nodes from high volume nodes. When we have these ledges, those are going to be key trading areas as well, where we expect prices to hold. So let's go back into what we were talking about. So using our large distributions, we can identify what the possible large directionality for the market is. Markets are going to use ledges of larger distributions as inflection points. So what I mean by this is, if we have, let's draw out two distributions here, right? We can draw out the blue distribution down at the lows, and then we have the green distribution here at the highs. So this is one distribution, below is another. So what generally happens is price rotates and holds the rejection of the distributions as prices within it. At a certain point, price might escape, and it's not very common for price to accept into a new distribution block the first test it's had in a very long time. So the anticipated move, right, which we had over this last week, would be the rejection of the start of the distribution block to come down and find volume where it was very comfortable before. Now, if this is going to stay expansionary and we're going to continue that leg to the upside, this area is going to reject as well, and then we can find that potential balance in the distribution above. This is the general theory of how these distributions and balances should play out realistically. Obviously, when you get to those ledges and those distributions, you do want to have confirmation of some sort to make sure that these areas are actually going to hold or what they're going to do. So markets will run into the next distribution. If there's low volume in between those two areas, right, it's going to run into that new distribution a lot quicker. Markets will use the edges of distribution as support resistance areas as well. And this is a classic image of this, right? So we have a few major distributions that are set up here on a very large scale. You can see how this was the most recent distribution that we were trading, right? On a larger scale, of course, because distributions sometimes they're not as easily defined, but you can see tops and bottoms trading. You're getting the escape of that distribution. So the expectations for price to run through this area. And even though this looks small, this is like a 20-point gap. And the idea is to accept into the distribution back above, right? So those are the ideas. This is how we start thinking about the big picture of directionality. A general rule of thumb is start on a daily chart when you're looking at these distributions. Go from 120-day to a 90 to a 60 to a 30-day profile. So change the length of the volume profiles to get distributions, because if you're in a scenario like we've been in recently, where we've continuously tested a top without actually breaking through, and we finally break through and there's no real volume above, you don't necessarily know what the levels are, what the distribution blocks are, all that good stuff. So it's just not that obvious. So you want to make sure that you get a full picture of where these distributions are. Another thing I like to do is I'll drop down to an hourly chart when I'm on the 60 and 30-day profiles, so I can get a little more information from that, right? A little time frame shift. And then we identify our major distributions from this, and we start understanding market directionality a lot better. We can break down the key ledges as well. So key ledges are going to be, they can be within distributions as well, right? If you have a 50, 60 point range, the chances of having levels between those 60 points is very high, right? There's obviously going to be some kind of distribution ledge in there. However, those ledges in those major distributions, they should be taken not as directional as if you break out of distributions or hold the ledges of those distribution extremes. For example, if we have two distributions and the extreme is 4,000 and 4,100, keeping numbers simple, and you have a level at 4050, right? Trading the extremes up or down into 4,100 or 4,000, I think are a higher probability to see strong-handed participants than trying in the middle of the range. We can take a look at TradingView and try to discern these major distributions together, right? We've already done that though, so I'm not going to break that down. We're going to look at that in just a bit. But another very important aspect about market direction, and this is something that I think a lot of people do know, but maybe underutilize, is the opening and closing prints on the market, right? This is very, very vital to understanding if a range is going to play out or if a trend day is going to play out. Trend days are where people get super excited, especially after the markets have been so sleepy and these conditions have been stagnant for months now. So being able to identify a trend day should make you happy realistically, right? We've had multiple of them this week. However, the problem is that people get so used to a compressive period, a range, that when the trend does come, they miss it or they fade it continuously, expecting to see the same old stuff. Now, if you understand opening and closing prints, you can start avoiding these traps by understanding if the market opens outside of compressions, the extended move is to be expected. So depending on where the market closes based on the distribution, you can get a sense of what the continued move might be in the following days, right? Because that closing print leads into an opening print for the next session. So if there's a large distribution block above and the market manages to close the session within, we can expect a move towards the upside, right? So let's see. Let's take a look at this. We have a distribution to the upside, right? This is an example from a bit ago. Our distribution is 4,023, right? And that's the start. The top of it is 40.48. So the green box are distribution, our major distribution. That's the start and that's the end. Prices close at 40.30, meaning that our opening print for the next trading session is going to be around 40.30. Now, when we run into a distribution like this and test the midpoint of the distribution or even further, the expectations are for that distribution to hold in balance, meaning you can buy the bottoms of the distribution on pullbacks and look to try to sell the tops. So you can see right here what happened, right? We break through, we buy the bottom, it runs into the top of the distribution, the top rejects, it runs down to the midpoint, and then we get some kind of opening print on the next session above. We try to run, right? And then we get kind of a mixed bag of nuts. But still, that mixed bag of nuts, if you understand distribution theory, is very playable. Depending on where the market opens on the regular trading hour session, we can expect a move based on the distribution as well. So let me take you through the thought process of what had happened on today's session, right? Today's distribution block, because it's fresh. It's fresh in our minds. We've seen it multiple times. And this is the screen. So these are my distributions. The white blocks are my distributions. What had happened? Yesterday, right? This is the closing print. The closing print, we managed to close somewhere within the middle point of the distribution that starts at 4,223, 22, whatever, right? It's not, the levels aren't going to be super exact. And the top end of it, 4,250. So based on distribution theory that we're now within this distribution, what should happen? We should hold the bottom end of the distribution and run towards the top. The top's expected to reject, right? We do get a slight rejection of the top end of the distribution. But if we take into account what we just learned, we open above this major distribution, right? Meaning that this compressive period is over and we're expecting an expansionary move, which is exactly the run that we see. And not even just that, when we pop up after the open, we pull back and hold the tops of the prior distribution, which was the long that I was mentioning today at 51s, 52s, 53s, for that expansionary move, eventually climb in and accept the distribution. So thoughts are, we should be moving towards the top of the end of the next distribution. So this is why I was leaning bullish today, because we're opening above distributions. The expected move is to the upside based on the understanding of distribution theory, right? And you guys might be wondering where I got these distributions from the tops. They're from prior areas. You have to dig back and find those, right? So where prior prices traded, right? If we zoom out a little here, let's go to an hourly because I don't know how far this thing can zoom on a 5-minute. I don't know if it's going to zoom because TradingView's been kind of a pain in my ass recently. You can see how well the first test of the start of the distribution holds rejection, large rejection multiple times. This isn't just like pure luck that these levels in these distributions work, right? They're found and they're used and they're constantly used and accepted for a reason. So I don't think I can scroll back on this to show you where I found these distributions from, but one of these days I'll show you. So that's the importance of finding where those major distributions are, because you can understand what the expected moves and directionality of the market are. All right, thank you. So let's take a look at this, right? If we open within a distribution, realistically, we're expected to hold within the distribution, meaning that prices are to reject the tops and the bottoms of the distribution containing balance. If we open outside the distribution, we expect to run into the imbalanced area until we find another distribution to reject and then maybe accept. Right? If we understand these principles and understand this distribution theory, we can understand the directionality of the market to a higher degree, right? Obviously, it does take some practice. It does take some looking into things, blah, blah, blah. So, for example, the green boxes are distributions. In example one here on the left-hand side, the open is within the distribution. Even though we're within, it's close to the top, the expectations are for a drop down towards the bottom end of the distribution. Now, the bottom end of the distribution, the first test of it, it does hold, but eventually we do get a break. On the right-hand side, right, we open prices outside of the distribution, very, very similar to what happened today. We get a pullback into the top of the distribution start, and you get that expanded extension move that you're expecting outside of a top of a distribution. So you can find examples of these everywhere, right? Countless stuff like this. So we can also use Sierra charts and prior session distributions like the extended hours trading session to identify the directionality. But if I would have to rank everything in terms of importance, I would rank major large distributions at the forefront and then individual session volume movements second. So we can also use the extended hours trading session volume profile where we can see distributions and what the expected move is. If we open within the extended hours trading session distribution, we can expect the price to be fairly balanced. If we open outside, we expect price to be unbalanced and run, right? We would expect the ledges to hold and to hold out on pullbacks. But realistically, extended hours trading sessions, the volume profiles are very small. So I lean more towards looking at larger profiles. So market direction, a few things that we have to ask ourselves. This Sierra chart from today's setup, right? How pre-market today looked like, what it looked like. So pre-market today, we have to understand that if we take a look at the major distribution block, this is a 50-day profile here on the right-hand side, we have multiple different ledges. The main distribution starts somewhere down here, and you can see it's the fattest, thickest block of area. You have a mini support structure here at these 80s and 75s where we've bounced very nicely. You have a nice little block of support over here, right? And then you have this like kind of minute little distribution block here to start. And then you have one here. And obviously 4250, because we've talked about this billions of times, is going to be the top end of that distribution, right? So if prices manage to get up there, then I can see an extension to the upside. I think if we open prices closer to like 4230 today, we could have rejected this upside trend move and probably looked for some downside move. So when we understand where those major distributions and areas are on the larger profile, we want to see where price is in comparison to those. So naturally, price is outside of this large distribution, right? Very simple. Price outside of also this little mini distribution, medium distribution. It's about a 20-point distribution, but it's not exactly this big. So price is above two major distribution blocks, and it's coming into the top of this distribution. The ideas are, can we hold like this and get that pop, or can we just rally above the tops of this current distribution to get that next leg to the upside? Then what we have is individual profiles. This is where a lot of questions stem from today and yesterday. So the idea here is, after we identify these large distribution blocks, right, like this, all these big ones here on the right-hand side, you want to understand what the extended hours trading session profile has done right? The extended hours trading session profile, how I have it shaped up here with a TPO, you can see these two. If you combine each little duo here, you have a TPO attached to a volume profile. So the green TPO is going to be the companion of the extended hours trading session volume profile, right? So this is the regular trading hours session. This is the extended, regular, extended, extended, regular, extended, regular, so on and so forth. So I'm going to be looking at the profile of the extended trading hours session to give me an idea of what might the move look like immediately on the coming regular trading hour session. So number one, you always have to understand where you stand in terms of large distributions. Always understand where you are in terms of a large distribution. If I map out the large distributions for you, it's going to be a little easier for us to read, right? So this is a major distribution up here, right? And then we have one somewhere here. Oops, sorry. And we have one somewhere over here. Okay. So these are going to be our two main distributions. These are our major distributions based on a larger profile, right? You might disagree with me based on what you see on the right-hand side here, but these are the major distributions based on a multiple day large profile. They're based on like a trading view profile. So I just use Sierra for like mainly a lot of levels. If I don't have a continuous contract, it's a little more difficult to find these major distributions. So a continuous contract like trading view is where I would find these major distributions. So what had happened here, the market tells us a story. All of the market moves are noteworthy. They're stories, right? You have a nice cluster of volume here, which is going to be the gatekeeper for price entering back down into the large lower distribution block. So prices eventually they rally into the top distribution block. We don't quite hit the tops of it. We manage to drop down and close below this major distribution, which tells us that we have downward pressure into these mid 70s, where I would expect buyers to stall price from entering into the lower distribution band. So then you get the move back up. If you accept and close back up, what's the expected move? Let's go and tag that top. Now, individual session profiles. The individual session profiles here are colored. There's two distinct things that we understand from these. We have one, the value area, and two, outside of the value area. The value area is gray tone. It's that light gray that you guys can see, and everything outside of the value area is a different color. These different colors represent a percentage of the POC's volume. If the POC is the most volume that traded in that individual session, that means that the POC is the max. It's the most. It's 100% of the max volume, the POC. The colors outside of the value area are denoted from red to blue and everything in between, meaning we're going from red, orange, yellow, green, and blue. Hot to cold. Hot colors are low percentages of the POC's total volume, meaning that they're very little thin volume. And then greens and blues are very close to the volume size of the POC. So once you start seeing a lot of volume in terms of green or blue coloring at highs or lows, that represents the injection of stronger handed traders that can reject the immediate move of price. Doesn't mean that the price is going to reject aggressively. The immediate move of price, which can be a 5, 10, 15 point move. So when we see these, we can start analyzing the coming move for maybe like a pop and drop. Because if we take this whole picture in context, we're below this distribution. My bias is to the bear, so I can see this area, then I'm a bull, right? My bias is shorting into the 42, into the 4200s, whatever the area is, 4220s, down into 4175, and then 4175, bringing it back up to the 4220s and above. That's my idea based on these large distributions. Now, day by day. Because if I say that's my idea and I start shorting 4,200, I'm not going to have a 30-point stop, right? Even though I think that it's going to drop 30 points, I'm not going to have a 30-point stop, meaning I can get in wherever I want. When I look at the extended hours trading session, whoops. Just going to get rid of it. When I look at the extended hours trading session here, we got a lot of volume shaping up here, meaning some strong-handed longs are trying to enter the market. So my idea is let this thing pop. Where is it going to pop to? Some of the key areas, right? 4,200s or so. And then we can get the continuation to the downside into the area that we want to buy. Same thing, extended hours trading session, strong-handed sellers trying to push this. I want to be long into these lows. Let it drop. Where? Into the distributions. Let it run. This is one of my main secrets to identifying market directionality and creating trading plans. That's how I do it. It seems very simple, right? You have to understand where big distributions are, and you have to understand where the intraday players sit to get the moves into those areas. So let's talk about the creation of a plan. I drop down plans every single day at TRADEPRO Academy in the morning, breaking down what the idea is, if I have a bias, what the expected move is, where you can find strong-handed buyers, sellers, all that good stuff. Every morning, a trader should have a set plan, have a setup, have trades, everything in mind, what they're going to do on the day before the day happens, right? It's hard to predict the market, but with the information you have in front of you, there's a pretty high probability you can make very good educated guesses, right? Your hypothesis can turn into something great if you analyze it properly and take the risk when the trade comes to you. Just because we do a lot of analysis, if we don't trade it, it doesn't really mean too much to us, right? With the volume profile, we do this each day in Discord, right? Set this up. We have a long versus short bias. We have a pivot. We have target zones. The pivot, it's always a tough question because these aren't necessarily generic pivots that are created by highs and lows of previous days, blah, 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 this and that. These are pivots that are generated by understanding where longs lose and shorts win, and understanding where shorts lose and longs win, meaning the start of a new distribution, a key ledge, whatever the case is, right? There's no one set right pivot either. I might have a pivot here, and it might be because of this distribution. Johnny might have a pivot over there, right? Somewhere else based on his distribution ledge, right? So I'm not saying our distribution ledges are different, but he might deem a pivot that's far away the area that he wants to look at, while I deem something closer, right? So there always is a difference between a good pivot and a bad pivot, though, realistically. You have to think to yourself, realistically, where are longs going to continue winning, or where are shorts going to continue winning, and where do they lose phase? Man. So let's take a look at this. This is a trading plan that I had, I think it was yesterday. So this is the idea based on the large distribution. First, let's take a look at the cumulative large profile. This is how we find the overall trend and the balances. We're outside of our large cumulative profile, which we identified as 4170 all the way down into, or high 4160s all the way down to 4120s. So we're above that. We're sustaining a bid at that 4175. So I think that there's still continuation to see that next leg towards the higher distribution, right? It's not going to happen V bottom every single time, right? So my idea is we kind of stayed stagnant overnight, and I want to see if these ledges to the downside hold. So the first idea was see, okay, is 88 going to hold? If it doesn't, right, we can look a little lower. If we break under 80, 82, right, we're probably not going to sustain this. Like I said, if we come back to 74, I don't think that area holds well. That's why you want a higher low into these 80s where that block of distribution is, to identify those longs, strong-handed longs are coming in at more favorable levels for that leg up, a higher low. So session profiles, we can use this to visualize strong-handed traders. We don't necessarily have too much of a visual on the overnight profile. We had some, I think, strong-handed shorts at the top, which led to the push down into the 80. And then that 80 rallied 40 points by the end of the day, right? So that day in the live room, I tried the 80 at the beginning, took a stop on half of it, took profit on most, took a stop on like one or two lots on the rest of it. I should have let it go because it traded down to about like 78, 79. Then we just rocketed from there. So the idea, everything was there, but execution wasn't necessarily the best that day. Still picked some up, just not as much as we would have liked. The other levels and targets are self-explanatory. Honestly, they're just ledges and other areas that you can find around, just very basic ledges that can be a part of a distribution, that might not be a part of a distribution, right? Whatever the case is. In the prior slide, the pivot for me, you can choose pretty much any of these levels, right? I'm targeting the 4208. So if I have a bias that's leaning a little more to the upside where I want to see a drop in pop, I would say 80-ish is my pivot. So if we drop under 80 too aggressively, meaning we drop into the low 70s, the bears are going to win this battle, right? So that's how I would discern a pivot. And then all the other levels, they're just very generic levels you pick out of your ledges and your profiles. So how do we trade the plan? Stick to the trading plan, meaning long above the pivot and on pullbacks and short below the pivot. I think this is a good starting point for a lot of new traders. There can be fades above the pivot and below the pivot, obviously, but only trade those at major key large distributions, right? When you hit that ledge of a very large distribution. Just because you're above the pivot doesn't mean you can't sell that 50, for example, or that 22 that's been plaguing that short for time. So large distributions, starts and ends are huge fade inflection points. And these are the areas where you can realistically see very large moves against them. So this is what I had today. I want to thank you again for all of your attention. It's been a very long day. It's been a very long day talking about distributions and volume profiles. I hope you guys learned a lot about this. So if this is something new to you, I highly suggest you deep dive into distribution theory so you can understand the directionality of the market a lot better.